In this video, I'm going to cover the top 5 index that you can invest in India. And this is my personal investing philosophy. As you see right now, what's happening in the market, people are worried, the portfolios are going down. But someone who understands index investing is basically using this as an opportunity to buy the index because we are in the long-term game. So my own personal take on this market situation and what's happening right now is it's just a buying opportunity. And this opportunity, I'm not saying that it's going to go away and it's never going to come back, but whenever this opportunity comes, I just buy more of the index. So a very common question is, if you understand long-term investing and you're in it for the long game, a question would be, what are the best indices that we could buy, whether through an index fund or an ETF? And that's exactly what we're going to cover in this video. First of all, I'm just going to show you my portfolio so that you can see that these are the index that I personally invest in. Some of these I invest through the ETF route, some of these I invest through the index fund, but the mid cap 150, the next 50, the Nifty 50, the Nasdaq 100, and also the small cap 250 index, which is also giving like a decent buying opportunity. Apart from that, I also have the consumer beast, which is the only sectoral index that I buy, and the gold ETF to hedge my equity portfolio with gold. All of the other investments that you see here have been there for some time, but may not be the ones that I'm actively investing in. Now, from all of these things and all of the other investments that I have, I'm not going to pick each one of these and explain you the pros and cons and etc. because I'm personally not investing in all of them at the same time. I'm just going to show you the ones that I'm currently investing in because I feel that they're giving a very good buying opportunity, right? So I've shortlisted those. But before that, let me show you a little bit what's happening in the market, right? So this is the Nifty 50 index, and we're looking at it in the last 6 months. People have been worried about over the months of what they should do. Some people get too worried, they might start selling out, which as per me is the worst thing that you can do. And some people actually see that, okay, maybe I just want to hold to my portfolio. That's the second kind of person that you'll come across. And finally, the third kind of person is someone like me who basically would say, let me buy as much as possible. And you can see this if you look at my pay-ins. So we're just going to show the pay-ins and payouts, and you can see that the past month and so forth, I've just constantly been buying into all of my index positions, right? So what are the index positions that I've shortlisted? Now, these are the top 5. Okay, so we have the Nifty 50, which is going to get you into the top 50 companies of India. Then you're going to have company number 51 to 100, which is the next 50. Then you're going to have the next 150 companies, which are all mid cap by the market cap. And these 3 index, if you just invest in these 3, you're now invested in the top 250 countries of India. Now, where the market goes up and down in the short term, if you believe that India will grow as an economy, as a country over the long run, if you're looking at 10 years, 20 years and so forth, for me, even 10 and 20 years, honestly, are short term. I'm looking at it for 30, 40, 50 years, or even passing on my portfolio after I die and so forth. For those kinds of time horizons, this is an amazing way of investing, right? Because you're not worried about the market up and down, right? In fact, you see all of these things as opportunity, where you see all of your friends may be worried, maybe their portfolios are 10% down, 15% down, 20% down. And I'm not judging them. Maybe you have friends whose portfolio is 10%, 20% up as well. But at the same time, what I'm trying to say is that you get indifferent to the returns. You don't really worry about whether the portfolio is up and down. I made a video recently about my investing strategy in the falling markets, and someone commented that my portfolio is 10% up. And that's actually when I realized that my portfolio is this much percent up or down. Because what I am more worried about is, if you go into my holdings, is how much money I've put into the market, because this is the metric that really matters. If you're investing in it for a very long time, you can be sure that your portfolio is eventually going to grow higher, right? So all that matters is how much money can you put into the market, and how much of it can you consistently keep putting into the market, so that you're rupee cost averaging into the market, right? And there's no better time to rupee cost average or to put money into the market when everything is going down and everyone is worried, as we say, when there's blood on the streets, right? So that's the time when I would especially like to enter into the market. So we're going to put all of these funds into the chart so that we can just see how they perform. So we've seen Nifty 50. Again, percentage returns are not the most important metric for me. but I'm showing this as a way of comparison of the different funds that I've chosen. The more important metric is the time horizon. So if you look at the formula of compounding, the time is in the exponential, right? So the longer you invest, the better compounding you will see, right? Even with a smaller return rate, if you can invest for the longest period of time, that's the person who's going to win the race, right? So let's also put the mid cap 150 index, Nifty mid cap 150. And these are the top three, right? And again, this is not rocket science. I'm not telling anything crazy here. I'm not talking about momentum investing. I'm not talking about value investing. I'm not talking about getting any additional alpha. No fancy algorithms. I'm just talking about top companies by market cap. So now we have the top 250 companies here, right? You'll see here that the Nifty 50 index in this period is down by 9.47%. The next 50 is down by 19.43%, and the mid cap is down by 15%. So I also want to answer one more question which people have asked me. Why don't I just buy a total Nifty 500 or a Nifty 100 and so forth? Is because I want to split my investments into these three very strategically. Sometimes there could be a case, for example, right now I may want to put a little bit more in the mid cap, given that I have a little bit more risk appetite. Maybe my business is doing exceptionally well in these months, and I'm willing to take a little bit of additional risk. It could also be that in some cases where I want to put more into the Nifty 50, because when you buy a Nifty 50 and a Nifty Next 50 separately, the amount that goes into the Next 50 is going to be more concentrated in the Next 50. But if you buy a Nifty 100, there's going to be more concentrated on the top 50. And let me show you what I mean, right? So if I was to go to ticker tape, and let's pick the Nifty 50 here, and let's see the portfolio, right? So if I was to put 100 rupees in Nifty 50, 12 rupees will go into HDFC Bank, 8 rupees will go into Reliance, 8 rupees will go into ICICI, 6 rupees will go into Infosys. And when you consistently keep putting this money, based on the index weightage, the amount that goes into each of these companies will change as well, right? So for example, if HDFC was to be 10% of Nifty 50, then in that case, if you put 100 rupees again, now only 10 rupees will go into HDFC. So it's auto-managed for you. You don't need a portfolio manager, which is why these are also known as passively managed funds. Index funds are passively managed. Now let's go into a Nifty Next 50. Okay, that's the second one. Now, if you look at the companies that are part of this index, you see that if you put 100 rupees here, 6 rupees are going to go into Zomato, 4 rupees are going to Indigo, 3.45 rupees are going to go into Jio, Vedanta, Pepsi, and so forth, right? If I was to look at Nifty 100, right, let me just open Nifty 100 now. And now let's say I'm saying that because I want to invest both in Nifty 50 and Next 50, let me just put all of my money in Nifty 100. But this is the problem that happens. If you put 100 rupees in Nifty 100, you'll get 10 rupees in HDFC, 7 rupees in Reliance. And if you scroll down, like the top 50 companies, even before we reach the Next 50, you're going to be spending most of the money in the top 50 companies by virtue of the free float market capitalization that these companies have, because it's so high. So at the end, you'll see that less than 1 rupee is going to go into the Next 50 companies. So if you want to manage your portfolio better, which is what I do, I invest separately into these. So I invest separately into Nifty Bs, which is my ETF of choice while investing in the Nifty 50. Now, I'm not saying that this is the best one, but this is the one that I've been investing in. This is by Nippon India. It has an expense ratio of 0.04%. If you look at the other ETFs, if you just click on peers, you can do this analysis whether on ticker tape or Tijori via Zerodha or anywhere else. You'll be able to compare the different terms, right? But for me, this is the one that I'm investing in. There's no specific reason, and this is not a recommendation. You could invest in ICICI, Nippon, any of these ETFs, if you decide to invest in an ETF, of course, and they're pretty much the same, to be very honest, right? So by that means I'm buying this ETF. As you can see, I've invested around 57 lakhs here, and by virtue of that, I'm buying these companies. The next 50, if you look at the one that I'm investing in, is Mirai Asset Next 50, which is 0.05% expense ratio. I don't choose the Nippon India version of this because that has a higher expense ratio of around 0.17% if I remember correctly. And this is the portfolio that I'm able to get into because by virtue of this. This is exactly the same thing that we saw on ticker tape, right? The next one is the mid cap 150. So this is the one that I'm investing in, mid 150Bs, which is by Nippon India. These are all just things that I'm investing in. They're not suggestions. They're not sponsored. So feel free to do your research and then take your pick as to which one you're investing in. Now, I want to make this also like a learning experience, which is why I'm sharing with you how these things work. If you look at the peers, you'll be able to see the other mid-cap ETF is another one that you could consider. If you look at the benchmark, so every ETF or every index fund will follow a benchmark, which is the benchmark that they are trying to track. This is the difference between a passively managed fund like an ETF or an index fund versus an actively managed fund. An actively managed fund will try to beat the benchmark, while an ETF or the index fund will just try to track the benchmark. And if they're not able to track the benchmark, they'll have something known as a tracking error. Okay, so if you look at, let's say we open the mid 150Bs. Right, let's try to find this one. This is the one that I invest in for mid cap. If you look at the peers, for instance, you'll see that this is the tracking error. So Nippon India ETF has a 0.09% tracking error. That's the error it has in tracking the index. Since this is automated, they're just trying to follow the index. It's not going to be as high as you would find in an actively managed fund. In an actively managed fund, we don't have the concept of tracking error, but what we have the concept of how much can it beat the benchmark by, right? And I'm not saying that there are funds that never beat the benchmark and you can do your research and you can find the fund. It's just that for me, I personally feel that having a simplified portfolio where I can stick to these indices makes the most sense for me in the long run. So we've spoken about these three, and as you can see, there are definitely buying opportunities in all these areas. Now we're going to talk about the other two, which is the consumption, the consume piece, and the gold ETF. So let's look at the consume piece, right? Now this is the consumption ETF. So this is Nippon India ETF consumption. It tracks the benchmark Nifty consumption. I truly believe that in India, consumption is going to keep growing with the rising middle class, with the additional disposable income, with the next generation investing in buying more and more products based on what aligns with their values. They are willing to pay more for those products. I personally work with a lot of e-commerce and D2C brands in India. I can see this trend on the rise. In fact, I have a big news which I will talk more about in the coming videos, is that I'm going to launch my own consumer brand in India. But yeah, we'll come to that in the coming videos. But this is the benchmark that this index is trying to track, and the expense ratio is 0.31%. You could also see a actively managed consumption fund, but basically these invest in the consumer companies. So Airtel, ITC, Mahindra & Mahindra, HUL, Zomato, these are all consumer companies that you and me use on a day-to-day basis. We know about these companies, and this is where I'm investing through the consumption ETF. This is the only sectoral ETF that I buy. I don't buy IT, I don't buy bank. And someone asked me this question, why not financial services, why not tech? Those are all decent ones to buy. It's just that this is what I believe in, this is what I'm doing. I know a little bit more about this sector than the others. And then finally the gold ETF. Now the gold ETF is very straightforward because it just tracks the price of gold. And what it's going to do is it's going to have 97.59% gold. So it holds gold as an ETF. So there's no storage stress, there is no making charges and this and that, which you would have if you were to buy physical gold. Of course, there are better ways, as you can see in my portfolio as well. I have some sovereign gold bonds, etc., which are definitely better because they give you something 2.5% or so every year. I don't know if it's that easy to buy a sovereign gold bond whenever you feel like, but at least for me, the gold ETF serves the purpose of being able to buy it at any time. So these are the 5 things. I would say in the current market situation, the top 4 is where I'm splitting my money, and how I'm doing that is as follows. I'm putting around 30% of the money in Nifty Bs, right? The next 20 to 25% approximately I'm putting in next 50, right? And then I'm splitting the rest between mid cap 150 and consumer equally. At this point, to be very honest, I'm not going very heavy or aggressive on the small cap 250 index. And that's something that I will continue to invest a moderately decent SIP style amount on a monthly basis. So this is my overall investment strategy philosophy. And these are the top 5 indices that I'm buying right now. So I hope this video was helpful. I hope it helps you navigate not just this market fall, but many different market falls, because this is the beautiful thing about this investing strategy, is that if you stick to this, you honestly don't have to consume a lot of content about personal finance and follow a lot of people. Even once you get this idea, you could just see from time to time what updates I'm making. You don't necessarily need to subscribe, though if you do subscribe, it really helps the algorithm. It also will help you see if there's any updates that I'm making to my portfolio. And like I said, I'm launching a new business, so I will definitely talk more about that in the coming videos. But that's all for this one. I'll see you in the next one. Bye.